watch CNBC and the people that come out one after another, they're still skeptical of this rally. They're still positioned defensively because they think there's, at the very worst, they may have abandoned their calls for 3,200 or sub 3,000, but some still are there. But many of them still believe we've got to have at least a 10 or 15% pullback here. This is crazy. So they're all kind of defensively positioned or less than fully bullishly positioned, waiting for that entry point that I don't think is going to come. And as a result, and particularly now that you're moving to new highs, I think pretty soon it's probably going to have to push through 5,000 and keep going. But at that point, I think they're going to abandon that, cautiousness and say, hey, we can't wait any longer. This thing's got legs.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Boehm. Today, we're going to discuss a macro scenario that may be unfolding before our very eyes of a parabolic market meltup and subsequent bust to follow. And we're so fortunate to sit down with David Hunter to discuss all of this in detail. David has 50 years of Wall Street experience. He has decades of experience in investment management and as a sell-side strategist. He's the Chief Macro Strategist at Contrarian Macro Advisors. David's strong macro capabilities combined with a contrarian philosophy have allowed him to forecast economic cycles and spot market trends well ahead of the consensus. David, thank you so much for joining us today.
Yeah, hi, Gary. Great to be on. Thanks for having me.
All right. So, David, you've been sharing for some time now about your market and economy thesis that includes a historic meltup first and then a major bust to follow. Can we begin with you sharing basically a 10,000-foot overview of your thesis before we go into the specifics?
Sure. Yeah, my view is that we're coming to the end of a 41-year secular bull market. So started back in August of 1982. I date it back to that. That's not the typical, start to the secular bull market. A lot of people think it started in 2009 or, back in the early 2000s. But I think it really, if you go back, we've had pretty much higher lows and higher highs all the way through that 41-year period. One exception of a slight undercut back in 08, 09. But and I date it back to then because that's really when the disinflationary trend started. We went from high double-digit inflation and interest rates and have been trending down ever since until this last couple of years. And, that was the impetus for the big rise in the market because it was the inverse to the PE multiples. Multiples move up when rates move down. And so we had this we started with single-digit PE multiples back in 82. We've had this big run up into, it's gotten as high as the mid-20s on the market multiple, currently around 20. So, yes, you had earnings growth, but the big reason we've had a secular bull market has been that run in PE multiples and, the drop in rates. So that's where I start. The secular bull market, and I think we're coming to the end of that. We're going to have one last, and again, this is somewhat contrary, but actually quite contrary, but I think we are going to have one run to lower lows on interest rates in the next year as we face a global bust. But before we get there, I think we have this last run up in the market, what I call a market meltup, into a final secular bull top. It's driven partly, we obviously had the correction or bear market in 2022. People got very bearish. Sentiment got as bearish as I've seen in my 50 years. Everybody was on, as I say, was on one side of the boat. Was so sure we were going to lower lows back in October of 2022. And I was calling for a bottom there. And we've since been obviously up from there and are now at new market highs, all-time highs. I think this is still a case where you've got a big wall of worry, where you still have an awful lot, particularly on the institutional side, an awful lot of people scratching their head as to why this market's up here. They think that there's a lot of problems out there, that valuations are at an extreme. So in spite of the fact that they're kind of, to some extent, jumping on the bandwagon because of the momentum, they've got one foot out the door and they're still skeptical. So as long as we have that skepticism, as long as we have that wall of worry, I think this thing has quite a ways to go. And I think by the time we get to the final top, which I think could happen in the first half of this year, it doesn't have to, but I think it could happen in the next several months. By the time we get there, I think you'll have all that skepticism will have washed away, and people will at that point be telling you why there's a long runway ahead, why this is a new cycle, and we're not near a top. At that point, I'll be pretty bearish.
Yeah, so there's a lot there, and we're going to unpack that as we go through this. But I've got a couple of other questions before we start with the meltup area. What methodologies do you use to forecast economic cycles and spot market trends that have helped you to arrive at this current thesis that you have?
Yeah, I'm very much a macro investor. I tell people I use fundamental analysis, macro analysis, technical analysis, cross-market analysis, and combine that all with sentiment and put all that together. And as long as I'm getting to the same answers from all that, as long as each one of those is confirming the others, my conviction goes up. And that's where I think I stand apart, is to have a crazy call like this and have stood by it and had conviction in it for all this time. I couldn't have done that if it was only a couple of pieces, but most everything was kind of confirming the same thing.
So between August of 1921 and September of 1929, that was about an 8-year period. The Dow increased 600% from a low of 63 to a high of 381. After prices peaked, economist Irving Fisher proclaimed that stock prices have reached what looks like to be a permanently high plateau. The epic boom then ended in a cataclysmic bust. Is your analysis pointing to similarities to the Roaring '20s, or maybe another time?
Yeah, I'm not big on history. Obviously rhymes. It doesn't necessarily repeat exactly the same way, but it certainly does rhyme. And I'm very aware of the history. I will say this in some ways is similar to that. And I think the period we're having economically is similar to that in some ways. My meltup thesis and my bust that follows is not drawn directly from that. And I certainly don't do overlays. There's a lot of retail that loves the overlays and says, oh, we're tracking on. And my experience is most of those overlays ultimately fail. So that's not how I reach conclusions or how I reach this conclusion. But for sure, again, that was a period where we were late in a cycle where inflation, where things got overheated to an extreme extent after many, many years, and particularly coming out of World War I. And then, you had policy mistakes made by the central banks back then and by the government that led to a depression. So in some ways, there are certainly similarities that can be drawn, but I think there are differences as well.
Okay, I appreciate that. So you call yourself a contrarian investor, and in your analysis, I'd like to know, what is a contrarian investor to you, and how does that mindset help to guide your cycles and market trends analysis and even your own investment decisions?
Yeah, I really think sentiment plays a big role. From early on in my career back in 1973, I became aware that the majority oftentimes got things wrong and understood the discounting mechanism of the market. It for me, when I do my analysis, sentiment plays a very big role. When everybody's, and particularly at major turning points, when everybody's bearish, I tend to be a lone bull. When everybody's bullish, I tend to be a pretty lonely bear. But I'm not a knee-jerk contrarian. It's people will say now, because we've had this nice run from 3,500 on the S&P to almost 5,000. And people go, I'm hearing a lot of people that are joining your your view? Aren't you nervous? And I go, it's very important to understand that it pays to be a contrarian at major turning points, but somewhere in that big middle, the consensus is often very right. So I'm not one that will say, gee, too many people agree with me. I'm going bearish here. You have to really kind of know where you are in that whole process.
Yeah. So before we move into any specific questions regarding the melt-up portion of your thesis, I've got a question regarding the current business cycle. So from your perspective, did the business cycle that started after the 2008 great financial crisis actually end during the pandemic, but was cut short because of all the Fed printing and easing and government stimulus that followed? Or are we still in that cycle since 2008, which is extremely stretched beyond the average cycle length, and we're expecting the end of this cycle to end in recession, as all cycles typically do?
Yeah, the hard part about cycles and this cycle in particular is people want to fit everything into a tight box. And frankly, I think you can answer both to that question, because in some ways we're still in that same cycle. There are certainly some trends that are still, in place since 08, 09, or since the fall of 08, 09. But in other ways, there's no doubt we had a recession. Might have only lasted a quarter, but they took the economy down 30%. I mean, you can't not call that a recession. So, certainly in some ways, it's a new cycle since 2020. But the problem is, it's some of both. So it's just a kind of an aberration of a cycle, and we know why. I mean, we saw how it happened, and we shut down the world's economy, and then just flood the system. I mean, as I tell people, in October 2008, when the great financial crisis was starting, we had a Fed balance sheet of $875 billion. It grew to 3.7 trillion in response to the Great Recession. We then grew it up, from there, as a result of the pandemic, the response to the pandemic, we grew it to 9 trillion. So we went from 3.7 to 9 trillion in a matter of a couple of years. We're in unprecedented territory. And that, I'm a monetarist to a great extent. And to me, money matters more than anything. And so when you print that kind of money, you're going to have results somewhere down the road. The leads and lags are tricky, but you're going to have results down the road that are going to be both inflationary and you're going to run into lots of problems. So I think we did start to see that, and obviously in 2022, the Fed had to respond. They started slow, and then got religion and tightened. Central banks, you go back and look at history, certainly in my 50-year history, central banks always go too far in both directions, and what you get is booms and busts. Greenspan did a little better job of kind of trying to anticipate the turns, and as a result, you got a more elongated cycle. But what I see right now with Jay Powell and with this current Fed is that they start too slow. They were looking at it as transitory, and then finally realized, hey, we got to do something. And now they're staying too far on the other side, trying to make up for what they did. They don't want to be criticized for being too quick to ease. So they're still, I think they're overly focused on inflation that has typically an 18-month to 2-year lag, and they think that they need to get inflation down near their target. Well, that almost guarantees you're going to be a year or more too late. And I think that's what we're going to end up with is, that they tightened too much. By the time they realized that we were already in trouble. And as I say, what separates this cycle from past cycles is the leverage in the system. Now, 2008-9, we had a lot of leverage, and that's why we got what we got. This time around, we've blown that away. You've got right now we've got, you know, trying to think of the debt now has gone beyond even the 300 trillion that it was. I think it's 320 trillion now globally, and derivatives are quadrillions in notional value. So, as I say, debt is the leverage on the system, and derivatives are the leverage on the markets. And when you've got both of those through the roof, nowhere near anything even back in 2008-9. I learned in business school, leverage works both ways. On the way up, it really enhances returns. On the way down, it really exacerbates the disaster. And so that's why I'm calling for a global bust following the meltup. And I define a bust as something bigger than a recession, but not as long as a depression. It'll be more of the time frame of a recession, but with bigger financial calamity.
Well, I appreciate you answering that. That is a question I was going to ask for your definition of a bust. So I want to move into the meltup right now before we get to the bust, though.
Sure.
And get your thoughts on the meltup. So let's start with, are we currently in the meltup phase, or is that still to come?
Yeah, I said back in early November when we had those first big days out of the market dropped from 4,600 to 4,100. Just below 4,100 in late October. And then we had like that next week, we had 3 or 4 very big days. And I said, we were in the bull leg. I was calling it a bull leg from October of 2022, the bottom, and all the way up to 4,600 when we corrected, and then came out of that 4,100 level with the kind of oomph we had. I said, it looks to me like the melt up portion of this bull leg has begun. And I still stand by that look what happened in November, December. It clearly to me was, what I expect in a melt up is a steeper, more dramatic rally is what I would call it. And then it moves into from melt up, it moves into parabolic melt up, which will be the final phase. We're not there yet, but we are in the melt up, in my opinion.
Okay. Interesting. So in your analysis of the melt up, what do you think is causing the melt up? Is it all sentiment? Is it something else?
There's two.
Is it greed?
Well, certainly greed's a part of it, and is in every big rally. But what I think are the two components that are most that are causing this. One is, as I said before, the bigger picture, not right now, but the bigger picture of sentiment was that everybody got on one side of the boat. The retail was bearish, but even more so, institutions, one after another, told you why this market had to go down and why they were cautious. That obviously momentum in the tape, what I call momentum of the tape, ultimately moves people away from that extreme view of bearishness. But if you just watch CNBC and the people that come out one after another, they're still skeptical of this rally. They're still positioned defensively because they think there's, at the very worst, they may have abandoned their calls for 3,200 or sub 3,000, but some still are there. But many of them still believe we've got to have at least a 10 or 15% pullback here. This is crazy. So they're all kind of defensively positioned or less than fully bullishly positioned, waiting for that entry point that I don't think is going to come. And as a result, and particularly now that you're moving to new highs, I think pretty soon it's probably going to have to push through 5,000 and keep going. But at that point, I think they're going to abandon that, cautiousness and say, hey, we can't wait any longer. This thing's got legs. That I think is a part of it. And then the other big part of it is we can spend all the time we want. And this is what Wall Street and the social and the outlets like CNBC and Bloomberg love to spend their time on, is when is the Fed going to cut? How much is the Fed going to cut? What month are they going to cut? To me, that's not the important question or the important story. The important story is the tightening cycle is ending. And sometime in the next several months, they're going to start easing. And so as I say, we've really had that tightening cycle narrative as a headwind, not just in 2022, really going back to the middle of 2021, even though the market carried further, the beginnings of the discussion of needing to tighten started then. And it was just a foregone conclusion the Fed was going to need to tighten. And then it picked up speed, obviously, through 2022. And it's been with us ever since, even now, obviously. And, so you take that headwind away, and then it becomes, move it into a tailwind of easing. That's a sea change for the markets. And we're already, this is somewhat unprecedented. We're at all-time highs in the market, and the Fed hasn't really begun easing yet. The other thing I say in that whole process is the reason I don't worry about what month they're going to ease or think that the Fed is the key from that perspective of exactly when, I go, is because the bond market leads the Fed. The rates will be coming down in the bond market before the Fed cuts. So I'm more interested in what are market rates going to do and when. And I think you had that big 120 basis point drop in the 10-year in November, December. You've consolidated that here. You had basically a 1/3 retracement back to 420. Came down from 5 to 380, back to 420. So you had a 40 basis point backup. And we're now just kind of in that middle ground trying to finish the consolidation before we drop to a new lower low. And I think we'll head towards 3% here in the next few months.
So, okay, that's all really interesting. So I just really wanted to make sure I understood you here. You had all these people and institutions in 22 who were sitting on one side of the boat. They were very bearish. They positioned themselves very bearishly. And then that they started to realize, okay, that was overdone, or it wasn't completely as necessary as we thought. They began shifting some assets, but not all assets, away. So they still have a very heavy or moderate to heavy bearish positioning. And now we're at the end of the cycle. And now they're going to be looking at the Fed lowering rates, easing everything, making it easier on them. And so there's this amount of assets and resources that have been sitting in the bearish side of the ledger that you're saying are now going to move over to the bullish side of the ledger, and that's what's going to help propel this melt up.
Yeah, obviously we've run a long ways already, so some money's been committed, certainly. However, what I think will happen is somewhere in here, the light bulb's going on, and it's like, what am I waiting for? I either get in now or I've missed, this thing. And I think I'm only guessing, but what I think will be part of the narrative will be this idea that soft landing or no landing, we're not going into a hard landing. And so what we're in is the bottom of the cycle, and that there's a new cycle ahead, that we basically barely touched the runway, and now we're off again. And I think once they think, 2025 and 6 and maybe 7 are a new cycle, they're no longer watching their downside. They're saying, hey, I got to get on board. This is early in a new cycle, which is crazy because you're at all-time highs. And what I think also will happen is I think it'll be very concentrated, because I think the light bulb's going to go off for so many. In other words, we're really in a herd behavior where everybody ran to the wrong side of the boat or ran to the other side of the boat. They've gradually kind of started, there's different people in different places right now, but they're still basically away from the right side of the boat. And I think you're going to see a buying stampede, because I think it'll happen in a matter of weeks and a couple months, where they're all going to say the same thing is, that bear story is behind us. What Mike Wilson was telling us is no longer the case. We were waiting for that, but we can't wait any longer because it's not going to happen. We got to get committed here. And frankly, it's not, this isn't just a trade. This is the beginning of a new cycle. The Fed's done tightening. There's room for, and don't forget, a lot of the economy, in spite of the fact that we haven't had a recession, half the economy, the manufacturing side of the economy, has been in recession. So now if the Fed's going to be at your back, you can start looking for that to come out of its, doldrums or out of its downturn, and start, that other part of the market other than the Magnificent Seven have a lot of room to run up because they've been actually underperforming.
So it's interesting you bring up the Magnificent Seven. What role does the narrowing stock leadership of the Magnificent Seven or six or five now, whatever they're called, what role does this narrowing stock leadership play in the meltup that you see happening? Is it more of a, okay, they're narrowing, which is now opening people's eyes to, the broader market, or how do you see that rolling out?
Yeah, I've been saying, this is very much a contrarian view that I've been sharing for a long time. Going back before last November, December, I was saying, unusually, I'm calling for obviously a major top here. I go, normally in a major top, as you get closer and closer to the top, the market narrows and narrows, and ultimately it's like in 1973 when I came into the business, you had the Nifty 50 take you up the last big part. I said, I think what you're going to see here is the opposite. As rates come down, you're going to have the growth stocks participating. As you start seeing the narrative switch towards, hey, new cycle ahead, you're going to see the cyclicals participating. So you're going to have a large cap, small cap, growth and value all playing. So it's going to be a broadening into the top rather than the opposite. Very unusual. This is not the way most market tops form. But I started saying that, well before last fall. And guess what? You look at November, December, and that was the beginning of that. You saw a very broad rally. Russell caught up, had a big catch-up rally. The cyclicals played pretty strong in that period. But you still had the Magnificent Seven. You still had the, semiconductors, which had been strong through this whole thing, continuing. So, and that's exactly what I think this will continue to be in the next several months is, it will be, you'll have your cake and eat it too. It'll be growth and value. It'll be small and large cap, Russell. And again, what happened in January is you had such a strong November, December that a lot of those catch-up groups, the small cap, the cyclicals, they've been correcting through January or through the last month. And so right away, the narrative switched back to, oh, it's just the Magnificent Seven. This is a very poor quality rally. You can't really buy this because this is the end of something. And I said, no, you have to realize, you have to put in perspective, where'd they come from late last October? Where'd they go to in December? And where are they now? And what you see is a consolidation of that big gain. And which means once you finish consolidating that big gain, the next leg kicks in. And I think that's what we're very close to now. As much as everybody's looking at this thing at 5,000 and up on stilts, when you look below the surface, a lot of stocks have corrected in the last month and corrected nicely and look like they're poised to come out of this and keep going, and resume their uptrends.
So it sounds to me almost like, from an investor behavior standpoint, like a reversion back to post-pandemic when all that printing led to euphoric speculative buying of literally everything, including monkey JPEGs for hundreds of thousands of dollars. It sounds to me like we may be reverting back to that in your thesis during this meltup. Is that a fair comparison?
A little bit. I would say the one thing I'd guard against, I don't think that this is going to be driven by new money as much as I'm saying the Fed is done tightening or close to done tightening. There's still QT out there, even if they don't hike rates anymore. They're starting to talk about ending QT, but I just heard the Richmond Fed president today say, I don't think we're close. We need to worry about that yet because the strength of the economy tells you don't need to stop. We still have room to take money out of the system. So I don't think my meltup thesis is not betting on another round of money.
Right. I was talking about the investor sentiment, the investor psychology.
Yes. I would say from that standpoint, yes. It's not as dramatic because you're not coming out, we're at 5,000. We're not coming out of a 35% correction that we had, or bear market that we had in March of 2020. I mean, the market went down 35% in 3 weeks, and we closed down the economy. So that was, we didn't know what was coming out of that. I called for the meltup then. Said we would go to 4,000 and then raised it from there to when we went to 4,800 in late 2021. So I was one of the few that back then, when everybody was calling for dire things and new lows, I said no. With the money they're printing, this is the beginning of something. So but that one was pretty dramatic. This is going to be dramatic from a different place. This one's going into a top. That one's coming out of a huge bottom, or a dramatic bottom anyway. But yeah, I think you are going to see in some similar ways that, you look at like your mining and metals, you look at the move from March of 2020 to August 2020 was unbelievable. I think that part of it, yes, I think you're going to see a lot of things play here in pretty dramatic fashion.
So are you seeing a FOMO kind of psychology that's going to be taking over even the institutional investors? And will this melt up include also foreign investors and institutions in your mind?
Yeah, first question. Yeah, I do think this is going to be FOMO very much. I think the final stage of this, what I think we go to 5,000 to 7,000, which is my target. I think we could do that in 3 months. Might not. I mean, people try to hold me to the time. I can't tell you for sure what it, but there's a setup here. We could go that fast from 2,000 points in 2 or 3 months, or it might stretch out to 6 months. I don't know. But either way, that's a phenomenal run. And yes, I think FOMO is a big part of that. Is FOMO. People are going to, again, think of yourself as a money manager whose bonuses and job depend on them, performing. And certainly they've underperformed the indexes for a long time. This cycle, this going back through the last 40 years. If anybody told you in August of 1982, you should, put your money in an S&P and not look at it for 40 years, you'd be a genius. But that wasn't what most people thought back then. But anyway, so yeah, I think money managers who have to perform, they're getting to a real pain point, right? I mean, they've got to be saying, I fought this thing all along. I can't fight it much longer, or I'm going to be out of a job, or certainly my bonuses are going to be impacted. So I do think, and just general psychology is really driven by momentum. I always talk about momentum of the tape is really what causes people to be bullish or bearish. And you're going to have maximum momentum, it's just going to feed on itself. So FOMO is definitely there. I forget what your second part of your
I was asking if you thought that there would be, if foreign investors and institutions were going to join in on this.
Yeah, my view is basically that I think it will be the global. The meltup is specific to the U.S. because of where we are in our cycles, and not time cycles, but, in terms of a bull cycle, secular bull cycle. You look at a lot of European markets and elsewhere, and they're not anywhere near the kind of, their markets don't look like ours. So I think they will participate. There'll be rallies across the globe. I don't know about China. China's in its own real problem right now, but certainly India's probably the closest to us in terms of being up sharply over the last couple of years. Europe's got big problems, and they're more. It's going to be a more muted rally, but I think they will certainly rally and be part of, because the same phenomena is going on over there. They're probably behind us, but the ECB has to at some point. Inflation hasn't come down quite like it has here yet, but at some point they're going to be moving from a tightening cycle to an easing cycle. I think they're several months behind us, so that will hold their markets back some. But the meltup is specific to here, but rallies elsewhere are certainly part of it.
Yeah. Okay. I appreciate that. So you mentioned 7,000 on the S&P. What are your other um, numbers that you're seeing? NASDAQ, Dow, et cetera.
Yeah, I just raised my numbers. I had 20,000 as a NASDAQ. I had a 6 to 7,000 target on the S&P, and in my January letter, I changed that to just 7,000. I said I don't think that bottom part of the range needs to be kept now. And I had a 20,000 target for the NASDAQ and raised that to 23,000. I had a 48,000 on the Dow, and I've raised that to 55,000. And Russell had a 3,000, which was way above anybody else. And I raised that to 3,300. So, I mean, these are, you're still, as far along as we are, you're still talking about 50% moves in some of these indexes. And I'm saying it's the first half of this year, likely. Again, timing is not my forte, nor do I think timing is part of a big cycle call like this. I give indications of what might happen or what I think looks likely, but I don't consider timing as really part of my call.
Yeah, these are all massive moves with massive amounts of assets flowing in. It's wild. So what do you see happening with the dollar during the melt-up phase, and is the impact going to be felt globally?
Yeah, I think the dollar is going to 80. So, we're at 104 and change or thereabouts now. It's been frustrating of late because it looked like it was on its way when it fell below 100. I expected some kind of consolidation there, but it's been consolidating for a few months now. I think it's pretty close to the end of this counter trend rally, and we'll roll over and probably head for 90 first. Maybe mid 90s first, then 90, and once it breaks that, I think 80 is going to come pretty fast. So, over the next 6 to 9 months, I think you could see the dollar fall from 104 to 80. That's a pretty amazing drop. I'm not sure exactly what will trigger that, other than again, we're going to have big run in interest rates to the downside. There's going to be the end of central bank tightening, all of those things, and certainly the Fed is in the lead position on that. The other banks are going to be slower to do some of the stuff. So that, the relative change is part of that.
Do you see the yield curve inversion stabilizing, going back?
Yeah, ultimately, yes. I'm not sure what happens in the next few months. My call is that we're going to see the 10-year down below 3% in the next few months, certainly by mid-year. The short rates will come down. I don't know. I don't know the dynamic of how fast. Ultimately, and I'm skipping over, but ultimately, I think you could get to 2.5% during the melt up on the 10-year. I don't know where because the shorter end depends a little bit more on the Fed. I don't know how fast they're going to be reacting. So, certainly curve will move from inverted, I think, at some point. But the real change then is during the bust. And it won't be a straight line. There'll be a move back up in rates somewhere during or shortly after the melt up, because I think the Fed will react to the melt up. And as I keep saying, I don't mean to jump around, but as I keep saying, there's no doubt in my mind that Powell bought hook, line, and sinker into Bill Dudley's thesis about the stock market being part of the financial conditions. And, for 2 years, since April 2022, he's been telling the Fed that, you need to get that down under 3,000. So that's why the Fed has constantly been concerned when the market rallies and tries to jawbone it back down. And you've seen it of late. Again, I think that's what that whole story about March was. He doesn't like that the market's running ahead of him on this stuff. So he may have abandoned the thought that he should talk it down to 3,000, but he certainly hasn't abandoned the fact that the stock market's causing problems for inflation. I think he's wrong to some extent, but I think if you get the market up to 6,000 or 7,000, he's likely to tighten again. I think that could be the era that brings on the final straw that breaks the back of the economy. But so I think you could see him tightening on the verge on the eve of a downturn in the world economy more aggressively. So I don't could he drop rates here, in March or May or whenever? Could you see a half point cut or even two cuts? And then next thing you know, he's hiking again? You could. Or we may not see by the time, the market may be far enough along that he abandons any cut and says, we're not cutting now, we're hiking. I'm not sure which scenario is going to play out, but either way, I could see where rates might go up rather than down for a little period of time. But so the short rate's a little harder to call in terms of the path it takes. But in the bust that follows, I'm calling for a 0% 10 year, and maybe even negative rates on the 10-year, definitely negative rates on short rates, less than 10 year, and probably a quarter to a half on the 30-year. So I'm very contrary, because most people think we saw the lows forever back in the lows of a couple of years ago.
Yeah. So staying just a little bit longer, staying on the melt up phase, I'd like to talk a little bit about the resources, what you think, what prices will look like for the metals, the precious metals, copper, base metals, battery metals, even oil, natural gas, coal. In your analysis, what happens to these resources in the melt up phase? What price levels do you see them going to? And does it cause a resurgence in inflation?
Yeah, I don't think inflation is going to be the reason why they rally. I think we're very close to a major turn. And I keep saying the key is the dollar. The reason they started to go and then they've been very disappointing this last couple months is because of the dollar. The dollar, instead of continuing down, turned back up in a counter-turn rally. It's the dollar's the story. It's not inflation. It's not deflation. It's interest rates certainly are a part of it. But I think the dollar is the real key for both gold and silver. And I think we're very close to a turn down in the dollar. And I think we're very close to a reversal, a major reversal in the metals, such that I think you could see, gold go from, where it is now to 3,000 in a matter of months. As I typically say, it's going to rally in the melt up. It's going to be part of the melt up, but it doesn't mean it's sequenced with the melt up. The metals have a lot farther. They're coming from a lot farther down, from a deeper trough, and where the market's not coming from a trough at all. So I think they could run longer. So it doesn't mean they're going to peak at the melt up top. They could carry for several months beyond that. So if, let's say, the melt up happens in May or June, the top happens in May or June for the equity markets, you might not see the gold and silver top out until fall, or summer sometime. It doesn't, there's no magic formula or says they have to. It's just simply they're coming from so far down. I think they have more pent up demand once they get going. And so my target is 3,000 for gold pre-bust. I use a pre-bust target, not a timing target, but whenever the bust hits, this will be the target before that. I think that's conservative. And I'm using 60 for silver. And I've said a couple times, it wouldn't shock me if silver blew 360 and went to 75. So, those are huge moves, both of them. Obviously silver typically in a bull market outperforms gold. And the gold silver ratio would come down to where I think it makes sense it could come down to if you saw those kind of moves. And then the bust hits, and I think the bust will take down almost all assets except maybe treasuries and the dollar. So gold and silver will not come back to here, but they'll be hit pretty hard because of a deflationary bust.
So going through the melt up, how do you see copper moving over the next 6 months? What about oil, coal, gas, and some of these other resources? What do you see? Is everything just going to be moving up higher over the next?
Not everything. Yeah. not everything. I am probably the bear on oil in the marketplace. I turned bearish when before it ran to 130, and in the Ukraine situation, when Russia invaded Ukraine. But I stuck with it when it ran. I was looking for a rollover, and then that happened, and it ran quickly to 130 for a couple days. And I said it's going back down, and I've been bearish ever since. And I've had a $60 target on oil. Called some things in between where I said there's a trading range, et cetera. But I still think that's where oil's headed in the next several months. And so it's mid 70s now. I think it can go down to 60. Ultimately, I think it goes below that in the bus, but 60 for the period in the next several months. So that's a one commodity that doesn't really fit with my scenario. Most of the other commodities, yeah, I think they'll rally. I think copper's going to $6. It's what, 370 something now. So I think you can get $6 this year, and again probably this summer. I think steel and things like that. It looks like you're going to have a big run in those stocks, so they're probably going to be move again. It's hard to separate out because I'm calling for the worst economy in post World War II era following this. So I'm not betting on this being a long, that there's fundamentals for this other than copper's in short supply, and if investors start believing that the cycle's turning up, I think it's that takes the prices up. It's not the actual fundamentals that ultimately happen to take it up. It's not a greater fool story. It's really just that we're in such a unique period where we're going to have what looks like the beginning of a new cycle, and then find out, whoops, like the road running off the cliff. Maybe that's not what is happening, So you can go take copper from 375 to $6 in a matter of months, and then take copper down to $1 in the ensuing year. I mean, that's what I think we're heading for. You can take gold to 3,000 in a matter of months, and then be back where we are today, 6 or 9 months later.
So you see this melt up basically culminating sometime maybe early to late midsummer is what it sounds like to me from what you're saying. So from now, February through June, July-ish is our melt up.
My view is I think there's a real possibility we could be there as early as April or May, or it might stretch out into the summer. That's I have people that, because I've said I've called for this melt up, and we've actually had 2 melt ups. That's another strange thing about this. We don't, melt ups are a very rare thing. 29 was a melt up, maybe certainly in NASDAQ, and 99, 2000 was a melt up. We don't get melt ups. I mean, and yet a lot of people, I've been using the term melt up for probably 5 years or whatever. And so a lot of people now and I know it came from, my exposure on Twitter. Now, a lot of people use melt up term a lot, but what they often mean when they say melt up is a nice rally. That's not what I'm talking about. This is something we never see. And we had 2 of them. We had, over 100% run in 2020, 21. In 21 months, we went, more than 100%, and NASDAQ much more than 100%. And then we went through a bear market, and this is a separate melt up. So I have people on Twitter constantly, often, once in a while, who will say, "You've been calling for this melt up for 4 years. What are you talking about? You don't know what you're talking about." And I go, I called the melt up in 2020 and 21. It was a separate melt up. This is a new melt up. It's crazy. It doesn't make sense. We've never seen this before, but that's the reality. Is this is a new melt up.
So will the Fed be continuing their tightening, the quantitative tightening, trying to decrease their balance sheet throughout this process through the summer, do you think? Or do you think that's going to change?
Yeah, I don't know what they'll do with QT. it's confusing. They take a lot of heat. Powell gets a lot of criticism, and I was his biggest critic. Certainly back in 2018 when he was tightening. I was critical of him several times along the way, but I've been defending him for the last year, saying he's been more right than most, in doing what they're doing. Everybody said, I said, even I was saying they're tightening too much. So far, so good. My concern is that other shoe is going to drop, and that he's making one of the biggest policy errors in history, along with Lagarde and all the other central bankers. However, up till now, you can't say that he's done a good job, or it looks like he's done a good job. QT. The problem is you had $5 trillion put into the system in 2020 and 21. The reason we have this elongated cycle and this so-called no landing or soft landing, whatever it turns out, or looks like it's going to turn out to be, is because there's still a lot of money sloshing around. So on the one hand, as a monetarist, I'm saying ultimately he's over tightened, and QT is going to be part of the problem. On the other hand, it's not the new money; it's the money left over from a few years ago that's still keeping things going. And you see it in other ways. You look at savings. Obviously, savings rates been drawing way down. You're starting to see delinquencies on credit cards, and people. We're in a have and have not economy. You've got half the, or a third of the folks are out there spending like crazy because their home values are up, their stock portfolios are up, they've got good jobs, and everything's fine. And you look at the bottom 50%, and inflation's killing them, and they're having trouble, making their budget every month. So it's a hard economy to really pinpoint exactly how policy is going to go in the next several months, et cetera. I'm pretty sure I get rates. I'm pretty sure they're not going to hike rates for at least the next few months, depending on how fast this meltup goes. But like I said, if they don't get to a point where they've cut rates before we get to 6,000 on the S&P, I doubt you're going to see a cut before we get into the bust.